Hi, Derek. Derek, you're muted. Derek, I don't know if you're there. How you doing?
How's it going?
Good. We'll get started. We'll get started in a minute or two. I'm so sorry that I couldn't run the class on Tuesday. I had a real medical emergency.
I'm sorry to hear that. It's all good.
Yeah, I had to run up to the urgent care center trying to figure out what's wrong with my foot. So I'm assuming we'll get a few more people rolling in here. Derek, let me just run into the bathroom, okay? And I'll be right back.
Yeah, go for it.
By then, we'll have some more people, I hope. Still just me and you, huh?
Yep.
All right. Well, I guess we'll get started. I mean, where's Zuzi? Where's Camden? Where's the usuals?
I don't know. I've just been really busy, so I haven't been to too many of the lectures. So I thought I'd stop by.
You catch up with them though, right?
Yeah, I do, and then I do the readings and whatnot.
Yeah. Okay. All right. Give me a moment to rack up the PowerPoint here. I think we went through chapter 5. We were up to chapter 6, I believe.
Yeah, chapter 7 is. I think it's chapter 7 now. Yeah.
Yeah, I think we might be a little behind, but let's see. Okay, that goes there. Yeah, I think chapter 6 is where we are today, Devin. Okay.
Okay. That's all good.
Yeah. This might be a little bit of an interesting chapter. We're going to learn about LIFO and FIFO and things like that.
Yeah. I think. Well, I know I already did chapter 6, but I think that's because it was due yesterday.
That's great. You got ahead of us then, I think,
Okay, sounds good. Yeah,
which
but
is terrific. Okay. All right. You and I will deliver the lecture together then.
I
Okay. Slideshow. Okay. Here we go. In chapter 5, they introduced us to the elongated income statement, where you take goods available for sale and you subtract your physical inventory to get the cost of goods sold. Now we're going to figure out how you do that calculation. So let's see what we have here. 3 learning objectives: how to classify and determine the inventory, apply inventory cost flow methods and discuss their financial effects, and explain the statement presentation and analysis of inventory. Okay. Our inventory in this course is all merchandise. That's all we have. We don't have material, labor, and overhead like you will when you get to 240, okay? So we're just merchandise inventory. It means we buy something and we sell something. And inventory is a current asset. We have 2 kinds of systems that we're looking at to monitor costs: a perpetual system and a periodic system. And we went over this in pretty good detail in chapter 5. In chapter 5, we learned that a perpetual system is one where we record both the sale and the cost of goods sold at the time of the sale, so that at every moment in time, we know exactly how much is in our inventory and what the costs are up to that point in time. A periodic system, when we sell something, we debit accounts receivable and credit revenues. Unfortunately, we don't do the cost of goods sold at the point of sale, which means that we have to wait until the end of the month to take a physical count. And then that physical inventory is subtracted from the available to get the cost of goods sold. So taking an inventory involves counting, weighing, measuring. Been participated in many inventories over my world. Goods in transit. We talked about FOB. You remember freight on board in the prior chapter, Devin?
Yeah. FOB, like the destination and shipping point.
Yeah, the FOB means the point in time where title passes from the buyer to the seller. And that's an important distinction. Goods in transit. These are purchased goods that are not yet received or sold goods that haven't been delivered. Goods in transit should be included in the inventory of the company that has the legal title to it. And that's all based on the terms of the sale. And we're getting back into FOB. FOB shipping point, freight on board shipping point, free on board shipping point. It means that exactly the moment the truck leaves the store, title passes to the buyer. We have a store on campus here in Santa Barbara, and we loaded up a truck with goods coming to my store in Newark, New Jersey. FOB shipping point means that I'm responsible for that truck as soon as it leaves the campus. Imagine the truck turned right on Cliff Drive and then tipped over and all of the goods were damaged. I would be responsible for that. It would be my responsibility, my insurance. I'm the one paying the freight. FOB destination, I don't own it as the buyer until it physically gets to my warehouse, okay? FOB, you could have FOB Chicago. It means that we'll split the difference, that this truck will belong to the seller until it crosses the Mississippi River, say, and then it becomes FOB destination at that point. Goods in transit should be included in the inventory of the buyer when it's FOB shipping point. FOB shipping point. Let's talk about consignments. Consigned goods. Consigned goods are the goods that we own, that we give away to other parties to sell for us. The consignee, meaning the person we're going to give it to, tries to sell the goods for us without taking ownership of the goods. Do you ever walk into Macy's department store and one of the first things you see on one of the floors are those glass kiosks with the women selling perfume? Well, that perfume is, a lot of that is consigned to them. Chanel sends a truckload of perfume to the store. The store sets it up on the shelves and tries to sell it. If Chanel sells the bottle of perfume for say $200, then they buy it from us for $50 or whatever we would normally charge. So that's what consignment is. Have to understand that the person who owns the consigned goods are not the people who have the goods physically, but the person who transferred them there. Rules of ownership. Has been company completed its inventory. It arrived at a total inventory value of 200. So they counted their inventory. And then we looking at some additional information. Has been included in the inventory goods held on consignment for false company. Held on consignment. Has been is holding them on consignment. That's not their inventory. So that has to come out. That still belongs to false. The company did not include a purchase which was sent FOB shipping point. we know that that $10,000 needs to be included. And then the third one, the company did not include in the count inventory that had been sold with a cost that was in transit terms FOB shipping point. Okay. So the first two we need to correct. The goods of 15,000, that doesn't belong with us. The goods purchased FOB shipping point should be added. And the third item was okay. So class, get familiar with FOB. It's an important concept. It can be used strategically. I worked briefly for a company that had a deal with a bank that we could borrow money against our inventory. Whatever our inventory balance was, I could borrow 70% of it immediately. And when we really needed cash and I had some wiggle room, I would call the supplier in Oklahoma and have them load up an oil car, fill up the rail car, and ship it FOB shipping point, which meant I could immediately borrow against that money. Apply inventory cost flow methods. Now we'll have a little fun, huh? Inventory is accounted for at cost. It can include all necessary expenditures to bring it in. It could be that you could be adding the freight cost to it, inspection cost perhaps, any refurbishing of the factory to get it in. And the unit costs are applied to quantities to determine the total cost of the inventory and cost of goods sold using these methods: FIFO, LIFO, average cost, specific ID. Let's start with FIFO. This is the most commonly used. First in, first out. What we're saying is first in, first out means that we sold the oldest item first. Whatever that item was, whatever oldest item is there is going to have the lower cost. So under first in, first out, we're always selling the lower cost goods first. Last in, first out, we are pretending that we're selling the most recent item first, even though we know that's not the case. But we're allowed to pretend that we are for accounting, gap, and tax purposes. Mesa Produce, up where I live here, they're on the last in, first out, it turns out. That means theoretically, they never sold the first banana that they put on the shelf back in World War II. Well, we know that's not the case. We know that's not the case, but we're allowed to work our way through it as if it is. Average cost is pretty simple, and I'll show you how to get that average cost. Now, specific ID, let's call this the easiest one to understand because they are showing you exactly where they got the goods that they sold. They're going to show you that. So the specific ID is it tells you exactly where you pulled the goods. It says the practice is relatively rare. Well, it's maybe it's rare, but you know who uses specific ID? Big ticket items like airplanes, cars. When I bought my Ford Edge about 5 years ago, they didn't tell me, okay, Bob, thanks for paying. Go out to the parking lot and take any Ford Edge you want and drive it off. No, they had to know exactly which one they sold to me. They had to know the serial number, the VIN number of the engine size, all that information in case of a recall or, God forbid, an accident and there's some legal action. So this company, Crivets, purchases 3 identical TVs on different days. Notice the cost is going up, Devin. All of the questions you're going to get on the test, at least as far as I'm concerned, will be in an environment of rising costs, which is how a healthy economy has to exist, with a little bit of inflation. You never want to see prices going down. That would be a terrible bit of deflation. So Kravitz sold 2 TVs. The question is, which ones did they sell? They sold 2 televisions for $2,400. Well, the sale is irrelevant. We just want to know what they're being costed at. They have to tell us. Now they're telling us. Kravitz sold the TVs it purchased on February 3rd and March 22nd. They sold the one from February 3rd. One was at $700. The other one was at $800. And the one for $750 is still sitting in the inventory. Make a little sense, Devin? I'm hoping. We're hoping.
Yeah, I got you.
Okay. So specific ID is pretty easy. And here they're just showing you that about half the world uses FIFO because it's easy and it's somewhat closer to specific ID, but not quite. Take a look at this screen here now. This is going to be the same for all methods of costing. We're starting with the beginning inventory, and we learned in the prior chapter that the beginning inventory plus your purchases gives us something called total units available for sale. This is a bookstore. They had 100, pretending it's a book. Well, it's a condenser. They had 100 condensers at the beginning that they paid $10 for. They brought in 200 more. Price went up to 11. Price went up to 12. Price went up to 13. That goods available for sale is going to be the same for all the methods. What the methods are going to do is break out that $1,000 and that $12,000 into the components known as inventory and the inventory and cost of goods sold. Nature of first in, first out. Costs of the earliest goods purchased are the first to be recognized. Okay. So you're going to start with the unit cost of the most recent purchase. So let's take a look here. How many did they sell? How many units did they sell? They told us that they sold 450. Okay. I'm sorry. They told us that there's 450 left in the physical inventory. So which ones are 450 left in the inventory? Which one is still in the inventory? We haven't sold the 400 yet. We sold the 100 at 10, the 200 at 11, and the 300 at 12. If we multiplied that out, it would come out to $5,800. Yeah, we sold the 100 at 10, that's 1,000, 200 at 11, and then 150 times 12 is 1,800. 1,800 plus 22 is 4,800 plus the 1,000. Just doing that in my head. This isn't clearly laid out as I would like. Hold on one second. Still just me and you, Derek. Unbelievable. Okay, hold on. I have a better presentation in Excel that I think will come up pretty quickly if I look for it. Okay. All right, let me share this. Okay, I assume, Derek, you can see it. Let me know if you can't see it. Here, we're going to talk about the 4 inventory methods. Here, we have a grid where I'm saying we sold 1,200 units. Sold 1,200 units. Under FIFO, which ones did we sell? Under FIFO, which ones did we sell? Well, we sold 400. We sold 400 plus 200 is 600 plus 300. And let me go back up. Start again. Let me take a deep breath. I'm going too fast. Deep breath. We sold 1,200 units. We had 1,500 available for sale. Which ones did we sell under FIFO? We sold the 400 first, 400 times 2. We sold the 200, 200 times 3. We needed all of the 300, 300 by 4. So that gives us 4 plus 2 is 6 plus 3 is 900. And we only needed 300 out of the most recent to go up to the cost of sales. So our cost of goods sold number here, Derek, is 4,100 after we multiply it out. And we have 300 left in the inventory. Okay. Let's take a look at LIFO. LIFO. Again, we have the same exact thing. We have the same available for sale. That's not going to change. It's the history. So that history is always going to be the same. Here, though, we sold it under the LIFO. LIFO. So which ones did we sell first with LIFO? We sold the 600, then we sold the 300, then we sold the 200. That gets us up to 6 and 3 is 9 and 2 is 11, which means we only needed 100 from this layer, leaving the 300 in the inventory at $2 a piece. So that's a quick look at LIFO, FIFO. We'll go back to the Wiley PowerPoints and continue on them in a moment. Let's look at the average cost. The two easy ones, the average costing. This is super easy, as long as you know how to get the average cost. The average cost is defined as follows: total dollars available divided by total units available. 5,600 divided by 1,520 is $3.73. So all you do is multiply 3.73 times 300 to get the ending inventory, and 3.73 times 1,200 to get the cost of goods sold. That one's not too bad. Don't make this mistake. Sometimes students say, oh, the average cost is 2, 3, 4, 5. They do that, you're going to come up with a Fakakta number of 3.50, which is not correct. That's not correct. You'll find out you're wrong. If you multiply them both out by 350, you would not cover the whole available. And then specific ID. We just talked about that a little bit in Wiley. Specific ID. I'm telling you here, 300 unit sales came from the beginning inventory and first and third purchases. So we got 400, got 300 coming. I guess I didn't finish this one here. Lending inventory. Yeah, we had 300 in the, I'm telling you, the sales came from the beginning inventory and the first and third purchase. So that leaves us a 300 balance in the 300 unit balance at $4 a piece. So hopefully that helps a little bit looking at it. And let me go reshare. Stop share. New share. Okay, we're back in the PowerPoints. So there's a look at LIFO. The way they're presenting it here, Derek, is they are starting with the inventory. They're saying, let's work with the number 450. And under FIFO, we sold the 300, the 100 at the beginning, the 200, that gives us 300, plus another 150 out of the 300. First in, first out. Nature of last in, first out. We're starting with the most recent purchase. Most recent purchase. And before I get to that, here are some examples. I like these examples. Here are some examples of where last in, first out does actually trace the actual cost. Think of things that are piled up all the time, like hay and coal. Hay and coal. But let me give you a clearer example. You ever go into a hardware store? In the middle of the hardware store, there's a barrel of screws or barrel of nails, okay? This thing is filled to the top with nails, 3-inch flat top nails, wood nails. Well, what happened was when that store opened back in 1950, the owner filled the barrel up. And then customers come in and they scoop out the number of nails they need and bring them up to the counter and pay for them. When that barrel gets to be 3/4 empty, they pour new goods on top. So you actually never do get to that old sale, the old purchase. So that's an example where LIFO reflects the real world. Let's take a peek here. Let's take a peek. What did we sell first here? We sold 400 plus 300, that's 700. What was available? I'm sorry. Let's go to the inventory. I hate the way they're presenting this. Normally, it should be presented the way I just did in Excel, where you do the cost of goods sold. So let's do the cost of goods sold. We sold, under LIFO, we sold 450. We sold 400 here and 150 from here. That leaves in the inventory 100 from the oldest layer. We never got back to the 200, and we got rid of half of the 300. Okay. Keep in mind that total available cost minus ending inventory equals cost of goods sold. Total cost minus cost of goods sold equals ending inventory. So when you're doing these problems and they say, give me the cost of the inventory and give me the cost of goods sold, once you have one, you automatically have the other. And another tip is this: if they give you a problem and they want you to tell them what the cost of goods sold was and the inventory cost, work with the smallest number. In other words, you might have 10,000 units over 5 purchases, and they're telling you that they sold 9,000, leaving 1,000 in the inventory. There would be easier to work with the lower number, 1,000, because once you got the inventory number subtracted from the goods available, you'll get the cost of goods sold. Last in, first out. Average cost we just talked about. Average cost, $12,000 is the total available cost, divided by 1,000 available units. That's $12 a piece. 12 times 450 in the inventory gives you this number, and then 550 times 12 gives you the 5,400 total cost of goods sold right there. Let me start again. Total cost was 5,400. The average cost was 12. 12 times 450, 5,400. Total available minus ending inventory equals 560. I'm having trouble reading that. $6,600. That would be 550 times 12. The average cost. Now let's understand the impacts, though. Let's understand the effects of these. FIFO, LIFO, and average cost are going to give you different net incomes. Different net incomes. So let's take a look at this. Here, we had the same available. That's not going to change. Then when we came up with the cost of goods sold and the gross profit, let's look at the income before taxes. The income before taxes under FIFO was 3,300. Under LIFO, it was only 2,500, and average cost is going to be somewhere in between, around 2,900. In other words, FIFO will always give you a higher net income. LIFO will always give you a lower net income, and the average will be in between. Now, that is assuming that prices are going up, that they're going up in the manner of a healthy economy, okay? If the problems are showing you that prices are coming down, then the rules reverse themselves. Hopefully, we're only going to be talking on the test and in future discussions about normal inflated economy. So look at the difference here. What happened to make this different? Well, what made it different was the income tax expense for FIFO is $990. It's only $750 for LIFO. Assuming these are big companies, that's what? That's $240 million maybe that LIFO saved in paying taxes. So one good reason for choosing LIFO is that it's going to give you the lowest taxable income. You're going to save money on taxes. So that's an attractive way to think about LIFO. FIFO, yeah, you're going to pay more in taxes. You're going to pay, in this case, 30% on your income. But this is a company that wants to make a big splash. They want to be able to announce record earnings. Our record net income, our record operating income was so much. They want to show the world that they really came out with a big number and they're willing to pay the taxes. And again, the average cost is in between. The average cost method is super, super easy. And I would imagine companies use the average cost method, although I've never seen it in my world, because of the ease of using it. And specific ID, which they should have listed here as well, they could be within the range of any of these numbers. That's the wild card. FIFO produces a higher net income because the lower unit costs are coming out first. LIFO produce a lower net income because the higher price stuff is being sold first. The effects of inflation. We're talking only now with rising prices. I'm not going to talk about falling prices because I'm a glass half filled guy. You understand how it works for rising prices. It's just the opposite for falling prices. The cost flow method that parallels the exact physical flow of the goods, well, none of these really do, but FIFO would be the one that would come the closest, okay? In a period of inflation, the cost method that results in the lowest income tax is, and we decided it was LIFO because they're selling the most expensive goods first and thus reducing their net income. And here's a problem they want us to do in class. Let's work on it together, Derek. We have a beginning inventory of 4,003, purchases 6,004. Determine the cost of goods sold under FIFO. Under FIFO. Well, how many did they sell? They have to tell us how many they sold. Oh, they do tell us, 7,000. Here it is. Right here, 7,000. Under FIFO, we sold 403 and 304. That's not too tough. Under LIFO, we started with the newest one. LIFO, 6,000 times 4 is 24, and then 1,000 to 3. So LIFO came up with an income of 27, and FIFO had cost of goods sold at 24. You had more expense. You had higher cost of goods sold under LIFO. Using the average cost. Well, we have $36,000 total available. Let's add up the available units. 4,000 plus 6 is 10. That's $3.60 per unit. Very simply multiply it out by the amount in the ending inventory and by the amount in the cost of goods sold. And here's a typo here. They got dollar signs on units. That should be 3,000 units without a dollar sign. 3,000 times 360 is 25.2. That would be your ending inventory. And the difference would be the cost of goods sold. And finally, explain the statement presentation and analysis of the inventory. Inventory is a current asset, usually shown right after receivables, and cost of goods sold is subtracted from net sales, okay? Part of the disclosure on the financial statements, they have to show their major inventory classifications. You know, it might be consumer goods or steel or something like that. The basis of accounting, they have to show that. Are we using cost, lower of cost or market? And the cost method, LIFO, FIFO. In a moment, we're going to get into lower of cost or net realizable value. And here's an example here, Walmart. And apparently the inventory at Sam's Club segment is valued using LIFO. The company's inventories are valued at LIFO. The disclosures that are so important. Let's talk about lower of cost or market. That's what net realizable value means, the market price, what an item is worth today. When the market price of an inventory item falls below the cost, we have to write down. We have to write off that loss. We must write down the inventory to the proper market price. And it's part of the gap principle known as conservatism. That principle says you always record and recognize losses when they occur, but you can never, ever anticipate a gain. You can only anticipate a loss. The gain comes when you actually sell the goods, okay? Net realizable value is the net amount a company expects to realize from the sale of the inventory. Lower of cost or market, when the value of the inventory is lower than cost, all right? Let's take a peek here at the concept. Kentucky TV has the following lines of merchandise with cost and market value. Okay, let's start with flat screen TVs. We have to come up with the inventory value for each of these 4 items. Well, the units are 100 and we paid 600 a piece. What's the market value now? It's only 550. What's happening is our salesmen are coming back to us, to management, and saying, we're stuck with these $600 TVs. No one's going to buy those old-fashioned flat screen TVs for 600. So we have to go select the lower of the numbers, lower of cost or market, which is lower. What's lower is the net realizable value. So we go 100 times 550 gives you 55,000 for that item. Let's look at the radios. We paid 90 for them, and apparently we're still able to sell them for 104. So what's the lower number? The 90. We don't have to do an inventory adjustment. We're just going to take the 90 times 500 to get the 45,000. Lower of cost or market on the DVD recorders. What's lower is the market price. 48 times 850 is 40,800. And here cost is lower. 5 times 3 is 15. You add those down, that becomes your total inventory balance. Inventory management's critical. High inventory levels, that's terrible. There's 2 terrible things with inventory: having too much or not having enough. If you have too much inventory, you are really tying up a lot of money. You're paying interest on money that you use to buy inventory. The storage costs can be enormous. You're paying people to drive forklifts around to put the stuff up in high pallets. The cost associated with obsolescence is going to be a problem too. You have inventory sitting on a shelf for a long time, it's going to get damaged almost inevitably. A forklift driver is going to drive into it, or somebody opens the box and drops something. So having too much inventory is not good. Having low inventory, that can be a killer too if you have lost sales. Someone calls you up and says, I want to buy 10 flat screen televisions, please. And you say, gee, I'm sorry, we're out of them, but we just ordered them. They'll be here in a couple of days. Can you call back in 2 days? Chances are the customer will say no and hang up because they know they can go elsewhere, okay? I was at a seminar at the University of Tennessee way back in the 1980s, and we saw at the time, the new Nissan plant that was being built nearby. And their inventory levels were absolutely minimal. They had enough inventory only for that day's production. Can you imagine that? When they got through building that day's cars, they basically had a clean floor. The reason for that is they had an arrangement with all of their providers of raw materials to deliver every day exactly what they needed. Every day they made deals with their providers. We will buy from you, but you have to agree to deliver every day at 4 a.m. in the amounts that we demand. And of course, that was more expensive to do that. It led to higher per unit prices. But boy, did they offset that with savings on storage costs, on interest, on money that is no longer tied up like crazy. So the lower the inventory, the better. The best inventory level is 0, as long as you can still make and produce and sell your product the next day. Let's look at a new metric. Remember the accounts receivable turnover ratio, where we took the sales and we divided by the average receivables? Here, we're going to take the cost of goods sold, divide by the average inventory, and then we're going to divide a year, 365 days, by that ratio to get the number of days. So let's see what we have here. Inventory turnover in 16 was 8.3. We divide 8.3 into 365, we get 44. That's 44 days Walmart takes from the time they receive the product in the store until they sell it. It takes them 44 days to get their product to market. Target takes longer. So just looking at those two numbers, Walmart has a real advantage over Target. The difference is about 18, it's almost 19 days. That's 2.5 weeks of inventory that Target has to carry compared to Walmart, and that can be very expensive.
Hey, Professor.
Yeah.
I actually have to head out pretty soon, but I had a couple questions I wanted to ask you.
Oh, go for it. No problem.
So as far as the extra credit assignments go that are due on Sundays, do you have to turn those in on that exact Sunday to get any extra credit, or if you do them at
we hope you can always turn them in late for partial credit, but let's try to get them in for full credit, right?
Yeah, okay. And then as far as the FSA assignments go, that's going to be like a project, correct?
Yes. There's an FSA I did, an FSA video that we put up on Canvas already, kind of explaining it. You're going to look at two companies, General Mills cereal manufacturer and Kellogg's cereal manufacturer, and prepare the different schedules. And then there's a 3-page write-up involved on top of that, where you tell us about the company and how they're doing. You'll be working with the 10K report and the annual reports and other sources you may require.
Okay, sounds good.
Yeah.
Yeah.
Now, Cornelius said there was a problem with the sound. I checked it the other day and it worked good for me. But yeah, I will in our next class, I will go into that in a little bit of detail, and so you guys can prepare that. Okay.
Okay, sounds good.
Yep. Anything else?
No, that'll be it. Thank you.
Okay, Derek, you can hit the bricks if you need to. I'm glad you were here. It's always good to have one person in the class anyway.
Yeah. Thank you. Have a good day.
You too. Bye now. And then there was one, just Bob. Who's in the classroom? Bob, nobody else. Inventory turnover, adjustment for LIFO reserve. Companies using LIFO are required to report the difference between LIFO and what the number would be if they had gone with FIFO. And that's called the LIFO reserve. And the LIFO reserve gets adjusted every month, up or down, depending on which is higher at the time, the LIFO inventory or FIFO. And it can bounce around kind of crazily. Here's an example. The inventory using LIFO was 8,614. But if they had used FIFO, it would be 1112. So the difference between the two is 2498, and that's your LIFO reserve. In this case here, you would debit the LIFO reserve for 2498 and credit the inventory. Okay. And they're showing you a ratio for the, well, we're familiar with the current ratio. They're taking, what are they doing here? They're taking the LIFO reserve. Oh, for heaven's sake. What they're showing you here is that the LIFO inventory, LIFO cost of 31,967, subtracting the 26,112, gives you a 10-point difference in the ratio, LIFO versus FIFO on the LIFO reserve. And I'll go over the LIFO reserve a little more prior to the next test, okay? Well, we're back on our famous lower of cost or market, or what they call net realizable value, which is the same as market. Here we have to figure out the value of the inventory. And I guess they're giving us the answer already, but realize all you do is pick the lower number. That's all there is to it. So our inventory is going to be 79, 250, and 101. Adds up to 430,000. That is our inventory. Inventory turnover number. We just went over that. It's going to be the cost of goods sold divided by the average inventory. So in 2021, the cost of goods sold is $1 million. The average is going to be 250. So $1 million divided by 250 is 4. Here we have 910 divided by, that's what, 210 and 50,000. I'll let someone else do the arithmetic for me. 1 million divided by the average comes out to 4, or 91.3 days. Here it comes out 910 divided by the average of 250, 210 and 50, 51 days. What this tells us, in 2021, this company took 91 days, took them 91 days. It took them 3 months to get their product from purchase to market. From the time they received the goods in the store till the time it left the store out to a customer, 91 days. The lower the better, obviously. Look at the big improvement they made the next year. And the next year, somehow they were able to really reduce their inventory level, which is a great thing. So they knocked their inventory level down from 210 to 50,000. They dropped it to like 75%. That accounts for that huge improvement. Apply the cost flow methods to perpetual inventory. This is a little bit trickier, although it's not the hardest thing in the world. But let's take a peek at it. Assuming the inventory perpetual system compute cost of goods sold and ending inventory under FIFO, LIFO with a perpetual. The only difference between the methods is this. What I taught you earlier today about LIFO, FIFO, specific ID and all of that happened at the end of the month. We waited till the end of the month. On the perpetual system, we're doing it on the fly. So look what we have here. We have a purchase. We had a beginning inventory of 100. Then we purchased 200 more at 11, 300 at 12. And they're working out the arithmetic here. And then they had shipments of, well, how much is that? That's 550. There's our 550. They're going to take the 550 and go back and pull the cost of goods sold from here. In other words, if it was FIFO, it would be 100 at 10, then it would be 200 at 11, and then it would be whatever we needed, 250 from the 300. It's FIFO within a shorter time period than an entire month. That's all that is. The simple way to say it is everything's the same until you get to a sale. On September 10th, we had a sale. So that means we got to work with what's in the FIFO layer now. November 27, we work what's above that, 413, and 50 still left over from the 12. That can be a little bit tricky, and I trust you're going to, do the homework with it and get back to me, with any questions or any difficulties with that. Same thing with last in, first out. What did they sell? They sold the oldest, the newest first. They sold 300 times 12, then 200 times 11, that's 500, and then they sold 50. So the cost of goods sold is 6,300 plus 5,700. And the average cost is going to change, of course, throughout the month. So here they have an average cost of 11.133. We know by the end of the month it was $12 a piece. Let's have a little fun with this. Failing to count the inventory correctly. That's a disaster. If you make a big counting mistake at month end, you are coming up with an erroneous, understated, or overstated net income this month, and then it's going to have the opposite effect on the next month. And I'll show you what we're talking about that. Errors affect both the income statement and the balance sheet. Inventory errors affect the cost of goods sold and the ending inventory for 2 months, not just this month. An error in costing inventory of the current period is going to have the reverse effect on the next period's net income. Over 2 years, the total will be correct, but you're going to have the wrong income in each of the 2 years. And that can really cause some big problems, as you might imagine. The ending inventory depends entirely on the accuracy of the counting and costing of the inventory. So if we botch that up, we're screwing up 2 years at one time, 2 months at one time. Just remember these 2 rules with ending inventory. Ignore where it says beginning inventory. We don't care about that. Ending inventory. If you understate ending inventory, you understate net income. If you understate the inventory, you understate net income because you're telling the world you're selling more than you really did. You forgot to count those items over there. You have, by accident, you put them into cost of goods sold. If the inventory is overstated, your net income is overstated in the current month. Just know those 2 rules. And here is a description of what happens when you make an error. Here, they counted inventory of 12,000, okay? Here's how it should have been. Here it is done correctly. They did their work and they correctly counted the inventory, $25,000. And we take that ending inventory and we bring it over here and we go through our work and they came up with another 10,000. They came up with another $10,000. They showed 25,000 in this period and 10 there for a total of 35. But look what happens when you botch it up. They made a mistake. They only counted 12,000. So their net income only turned out to be 22,000. Suppose this is a big company. Let's say that's $2 million. Well, the boss might look at that and say, geez, we lost $3 million. He said, I better lay off the third shift. You could easily lead management into a bad business decision by having a poor inventory account. So the next month, you're stuck with that 12,000. You're stuck with it. It's the beginning inventory, even though it's wrong. And when you fly it out, you're going to come down to 13,000 in income here, which is wrong, plus the incorrect 22,000. They both add up to 35. And let me just see if I have something here. No, I don't have what I was looking for, but that's okay. On the PowerPoint. There we go. Important lesson under state inventory, understate income. Understanding ending inventory will, understating the ending inventory will overstate the cost of goods sold because it understates the net income. The effect of errors. This is a better grid than the other one. Overstated, understated. Assets are going to be wrong. Equity will be wrong. And liabilities to no impact. Then they're just talking about a few rules on IFRS. There shouldn't be any real IFRS questions on the test for the most part. But what I would urge you to do is read through this part of the chapter and make a note of differences, okay? And don't worry about the similarities. So here they're talking about they both use historical cost and value. The requirements are pretty much the same. So here's a major difference. GAAP allows LIFO internationally, can't do it. No LIFO internationally. And that takes us to the end of the chapter. Sorry we didn't have a better crowd here. Again, I apologize for my shattered foot that took me up to the not the emergency room, but the urgent care guy on Tuesday. Okay, so keep up the studying. You know where I am. Today, I will be on campus from 4 until 7 o'clock in BC 204 or BC 208, which is right across the hall. I will also be live Zooming tutoring tonight, and maybe some of you can stop in and say hello and ask a question or two. Okay, so you all take care, and we'll talk again on Tuesday.